Really excited to be here. Really appreciate y'all inviting me to come and speak to everybody. And I'll just go ahead and jump right in. Of course, as you previously mentioned, my name is Henry Holt. I'm with Able Realty Capital. And just a quick background on myself. There's my contact information on the right. But was born in Houston, but grew up in College Station. Graduated with a finance degree from Texas A&M University in 2011. Immediately after, I went to go work at Comerica Bank in Houston, and I spent 2 years as an underwriter in the business banking division, and I underwrote over $400 million in loans. And then I became a loan officer and originated loans for 6 years, and so I spent a total of 8 years at Comerica Bank in Houston. And then 4 years ago, I became a commercial mortgage broker, and I've originated over $100 million in loans. So hoping to use some of my experience to educate, maybe help anyone who's on this call. If you would like more information about me, you can check out my website, www.ablerc.com. And if you want to connect to me on LinkedIn, we'd love to do that as well. And you can just type in Henry Holt and it should show up, and that's what it looks like. So today I'm going to be talking about kind of give an update on the debt markets. And so a lot's changed. And one of the things I want to discuss is kind of what's happened in the past and kind of go through some lessons learned from the past, look at the present, look to the future, and then go over some loan products. And really the loan products is kind of the meat of where I want everyone to kind of see what loan products are available today. But I also want you to see what I recommend as well. And the best way to understand what I recommend is based upon what I've kind of experienced. And so that's why we're going to go over kind of what has transpired over the last several years. And so before we get into that, though, it's important that all of us understand that there's really two types of interest rates out there. There's kind of long-term interest rates and short-term interest rates. And those interest rates are based on an index. And so if you're not familiar with an index is just a kind of a base rate. And what lenders do is whenever they're going to give you an interest rate, they start with a base rate and then they add a spread to it. So it looks a little something like this. And so you have your index plus a spread ultimately equals your interest rate. And so, you have your long-term indexes and interest rates, then you have your short-term. So let's look at the long-term. One interest rate that's available out in the market is the 10-year treasury. And the 10-year treasury is just if you want to lend the government money for 10 years, then you can do that. And you can see what interest rate they'll pay you to lend them money. And ultimately, the 10-year treasury is important to look at because it impacts fixed rate debt, specifically fixed rate debt that comes from Fannie and Freddie, and then commercial mortgage-backed securities. It also impacts bank fixed rate debt as well on kind of the larger banks that lend out money. And then you have kind of short-term interest rates and indexes as well. And so I'm sure a lot of y'all are familiar with the Fed funds rate. But if you're not, the Fed funds rate is basically the interest rate that the Federal Reserve controls. And short-term rates are largely based upon the Fed funds rate, what the Federal Reserve, the interest rate the Federal Reserve controls. And so you have two indexes or interest rates that are based off the Fed funds rate. One of those is really SOFR, which used to be called took over when LIBOR was kind of dismantled. And SOFR, it really impacts floating rate debt. So when you think short-term rates, you really should be thinking of more floating rate debt. And floating rate debt is typically associated with bridge loans, construction loans, and even Freddie floaters, which aren't as really popular today, but did show popularity at one point. And then also the other floating rate index that we should be familiar with is kind of the prime rate. And so this is really associated more with banks, and banks really lend off the prime rate. So if you ever hear someone say, oh, what interest rate did you get? Oh, I got prime plus 1. What they mean is the prime rate plus 1%. And the prime rate right now is actually 8.5%. And so, but the prime rate not only impacts floating rate loans, but it also impacts fixed rate loans for banks. So they actually look at the prime rate pretty closely for both of those. And so now that we kind of understand rates and the indexes, let's kind of dig into the past, because we're going to be looking at the 10-year treasury and SOFR specifically, and I kind of want you to understand what all that is. And so the first thing we're going to look at is kind of this pre-COVID period. So this is the chart of the 10-year treasury, and here at the bottom you have the years here. So this is from 2007 to 2023, really current. And then you have the interest rate here on the y-axis. So starting from 0 and all the way to 5%. And so this is kind of when we saw the recession. This was the recession of 2007, 2008. And then this is kind of the little miniature recession that happened with COVID here, right in 2020. Okay. And so the 10-year treasury, as you can see, kind of stayed a bit range bound here for several years. But these movements were actually pretty sizable actually. Starting at around 5% here in 2007, but then it kind of moved down as low as maybe 1.5%, and then kind of would move up to 3%, 1.5 to 3%, kind of in this incremental range here. And so during this kind of 2015 period to 2020, really the popular loan product at the time was like a Fannie fixed rate debt with some yield maintenance prepayment penalty. That was kind of the popular loan product at the time. And it was a good loan product ultimately because you could get a really low rate. You could fix your rate, say 3.5 to 5.5%, depending on what the 10-year treasury was at the time. And so as I mentioned, that this impacts your ultimate interest rate. And so if your base rate 10-year treasury is say 1.5%, and you add like a spread to that of 2%, then your rate might come in right at 3.5%. Whereas when rates are 3%, and then they might come in around 5% or 5.5%. And so these were low rates. They were fixed rates for a long term. You could get 80% leverage as well at the time based upon the sizing of the loan. And so this is what was really kind of popular at that time. And one of the reasons why it was so popular is because people thought interest rates were going to continue to rise, if you recall. And so what this is a chart of the federal funds rate. Okay. And the Federal Reserve kept rates low for a really, really, really long time, if you recall, from say 2009 to 2016. And so they actually had a term for this. They actually called this QE infinity, quantitative easing infinity, meaning they didn't raise rates for a really long time. They were going to pump money into the system indefinitely indefinitely. And so that's what this was ultimately called, this period here. And then rates slowly started to rise. And really what everyone thought at this time is if you're going to pump all this money into the system, then likely you're going to see inflation. And if there's high inflation, then that should cause interest rates to rise. And so people thought, at that time, hey, why don't I get a super long-term fixed rate, maybe a 10 or 12-year fixed rate loan, so that when interest rates rise to say 6-7%, then I still have that low long-term fixed rate. And so ultimately the Federal Reserve did slowly start to increase rates, as you can see here, from 2016 to say 2019. And as I mentioned, people love the idea of having a long-term fixed rate. They could lock in, and it was awesome. The longer, the better. And if they ended up selling the property, a lot of these loans they were doing, these agency loans that they were doing, were assumable as well. And so the next buyer could actually assume this low rate loan, and they could actually make a premium upon the sale. And so And so ultimately, what did now these agency loans? One of the features of them, though, is not all agency loans, but these larger agency loans, these loans, I would say greater than 7.5 million, really, and I would say below that, they had something called the yield maintenance prepayment penalty. And so yield maintenance prepayment penalties are this hard to calculate prepayment penalty. But what you need to know is that as interest rates rise, your yield maintenance prepayment penalty goes down. But as interest rates increase, your yield maintenance prepayment penalty, hold on, I think I might have that reversed. As interest rates rise, your yield maintenance prepayment penalty goes down. As interest rates go down, your yield maintenance prepayment penalty goes up. And so everyone got these long-term fixed rate loans here. And what happened was the 10-year US Treasury dropped from 3% here to, say, 0.5%. And so everyone had these huge yield maintenance prepayment penalties. And everyone that got a yield maintenance loan. And so, and not only that, when the 10-year US Treasury dropped, what happened was that cap rates also dropped. And so what you want to look at in this chart here is this orange line. This is kind of a graph of cap rates over the years. And we'll just kind of, look at 2009, and then we'll look at maybe 2015 here. So cap rates were around 5.5%, 6%. And then after COVID, cap rates, continued to go down to maybe 4.5%. Or 6%, and I have here 6% to 5%, 5.5% to 4.5%. Really, basically the bottom line is cap rates were dropping. And whenever you go to sell a property, you love it when cap rates drop, because ultimately the value of property goes up as cap rates go down. And so everyone wanted to sell, but they had these huge yield maintenance prepayment penalties. So people were really upset about that. So now that we've kind of talked about the pre-COVID period, let's talk about kind of what are some lessons to be learned here. So what were some of the mistakes that maybe people made at the time, or maybe it's not a mistake, but maybe they had to. So what did people do? They had yield maintenance prepayment penalties, as we discussed. And the problem is that as interest rate and cap rates drop, investors wanted to sell, but as interest rates dropped, the yield maintenance prepayment got very high. And so what can we do maybe different? Well, you could get a step down prepayment penalty if the loan is, say, somewhere between 1 million and 7.5 million for Freddie SBL, or you could get a modified yield maintenance prepayment penalty if it's a larger loan. And this is for agency loans. Of course, if you're getting some type of bank financing, you get a step down prepayment penalty or no prepayment penalty at all, so that you don't have this problem. The other thing that people did was they got long-term fixed rates. They got 10 to 12 years. And the problem with getting a 10 to 12 year fixed rate when you have a yield maintenance prepayment penalty is that it results in a higher prepayment penalty. If you have 2 years left on your loan, your yield maintenance prepayment penalty is going to be less. If you have 5 years left or 7 years left on your loan, then you're going to have a higher prepayment penalty. And so what can you do to not face this issue other than getting a step down prepayment or no prepayment or some type of modified yield maintenance? Is you can match the term of the loan with your expected holding period. Instead of, if you don't think you're going to hold the property for 10 to 12 years, let's say you think you're going to hold you're going to sell the property in year 5, then you should get a loan term that matures in 5 years if you have to get a yield maintenance prepayment penalty. And then number 3, maybe change your expectations. So people thought that they would benefit when cap rates drop. They thought they would benefit greatly. But if you have a yield maintenance prepayment penalty as rates drop, so is your yield maintenance prepayment penalty is going to go up. But hopefully the value of property goes up enough to where it covers that yield maintenance prepayment penalty. So I would say the other thing you can do is just don't bet on interest rates if you can avoid it as much as possible. Okay, so then what happens is COVID hits As I mentioned before, people got these agency fixed rate loans. The longer they saw it, the better. And so everyone kind of switched, and they were like, well, I don't want to have a really high yield maintenance prepayment penalty. What are some of the options? Well, why don't I get a Freddie floater? And a Freddie floater was a very popular product coming out of COVID. And as I mentioned, it's kind of this knee-jerk reaction, like, hey, we don't want yield maintenance prepayment penalties. When the cap rates go down, we want to be able to sell the property with no large prepayment penalty. And so these Freddie floaters, they had 1% prepayment penalties, and they were floating rate loans. And so you had the risk of interest rates going up. But what you did to avoid that is you bought an interest rate cap. Okay, and interest rate caps were actually really cheap at the time. And they were really cheap at the time because the market thought that rates were going to be low for a while. You know, we can look at this in hindsight and see that rates went up a lot, but nobody knew that when it was down here. Nobody knew that. Okay. So really, as I mentioned before, floating rate loans, it's better to, whenever you're looking at a floating rate loan, it's really better to look at SOFR if you can, because that's really what floating rate loans are based off. So we're going to be moving in between kind of the 10-year treasury and SOFR. And so this is kind of a complicated chart, but I'll walk you through it. So you have from 2001 here to 2023. And then you also have some years into the future here. Okay. And then what you have in this dark blue line, this is what LIBOR was, the LIBOR interest rate was, and this is what floating rate loans were really based off for the large part, until LIBOR transitioned to SOFR. Okay, and I mentioned before LIBOR transitioned to SOFR. Okay, and so this is LIBOR until it became SOFR. And then you have these kind of gray lines that are coming off of here. And so these gray lines are actually what gives this chart its name. It's called the hairy chart. And because it looks like there's little hairs coming off the actual interest rate at the time. And so what these gray lines represent is what the market anticipated rates would be in the future. These gray lines represent what the market thought interest rates would be in the future. So for example, let's just look in 2009. LIBOR was around 0.5%. Well, what did the market think was going to happen to rates over the next, say, 5 years? Well, they thought that they were going to go up. Okay, they thought they were going to go up. But what actually happened? Rates stayed flat. For years, they stayed flat. And so one of the things we can learn from this chart is the market. You know, if you ever think anybody knows what interest rates are going to do in the future, they don't. Okay, the market doesn't know. Nobody knows. Obviously, the Federal Reserve can control short-term rates, but you don't exactly know what they're going to do either, because they're data dependent, as they say. And so why is this chart important to our conversation? Because the reason why people got floating rate debt, and they got these Freddie floaters because they wanted the low prepayment penalty, the 1% prepay, is because they thought that rates were going to stay low. They saw a chart like this. The market expected rates to be low into the future, and they thought it would continue to be low. Never in a million years did anyone think that it was going to go like this high, this fast. And so they got these short-term, these floating rate loans, because they thought, oh, I'll just sell my property in a few years, and before I see the impact of interest rates. And so, but unfortunately, what happened is, rates went, through the roof. I mean, a huge spike in rates here. And these people got Freddie floaters. They were saved because they got interest rate caps, which caps your interest rate at a certain interest rate. But they only were required to have them for 3 years. And so at some point, they were having to buy new interest rate caps or escrow for a very expensive interest rate cap, which would happen into the future. And so, And so what people thought that, oh, rates would stay low, or they might gradually increase like they did previously. But what ended up happening? They went through the roof. So what can we learn from this? First off, I would just say nobody knows what's gonna happen to interest rates. So if you can, try not to bet on what's going to happen to rates. And the best way to do that is to get fixed rate debt. So what do? They got floating rate debt, and when in this case they didn't have to. Sometimes there's certain products where you're really kind of forced to, but in this case, they didn't really have to. Rates skyrocketed, their interest expense increased, and their cost of the new rate cap increased. And so if you can, don't bet on rates. Always get a fixed rate loan if you can. And then we saw this huge spike in interest rates. Federal Reserve raised rates, and then also what happened, as you can see here, is the 10-year Treasury went up quite a bit as well. And so people, but at the time, the new flavor of the month was kind of these, not of the month, kind of the period where these bridge loans, because ultimately the fixed rate financing that was available was the interest rate was so high that the leverage that they could get on the property was, say, like 65%. But if they got a bridge loan, which underwrites to future cash flows, then they can get 80% leverage or more. And so this is what people were doing. And bridge loans at the time had looked similar to the Freddie floater. And now there's more fixed rate bridge loan products, but back then there was less. It was more floating rate products. And so the way those looked is floating rate loan, 1% prepay, interest rate caps. But really, instead of underwriting the loan amount to historical cash flow like Fannie and Freddie does, you're actually underwriting to future cash flows. But as kind of I mentioned previously, nobody knew that rates were going to go up so high. Everyone thought they were going to go up maybe gradually, but no one thought that rates were going to go up like crazy. And the reality with bridge loans is, because you're underwriting to projected cash flows, you're also underwriting to a construction takeout loan. And to a permanent takeout loan, that is. You're underwriting to a permanent takeout loan. And so people would think, oh, well, whenever my short-term bridge loan is done, say 2 or 3 years, then what I'll do is I'll get a Fannie fixed rate loan at, say, 0.5% more, half a percent more than they are today. But what ended up happening was, the Federal Reserve raised rates, and what happened to? I'm going to go back a little bit. What happened to the permanent debt option, the Fannie fixed rate option that they could get? Well, it went from 0.5% to, say, 4%. It went up by 3.5%. I went up by 3.5%. So instead of getting a 3% or 3.25% or 3.5% loan on the takeout, they ended up, having to get a 6 or 7% loan. And so what can we learn from that? If you're going to get short-term debt, the challenge is anticipating the takeout. Whenever the takeout loan, whatever loan you're going to take out to, and so that perm debt option. So one of the things you can do is you can underwrite to multiple takeout loan scenarios. So you can underwrite to, say, back then, I guess it would have been a 4.5% interest rate. What does my debt service coverage ratio look like at 4.5%? Then what does it look like at 6.5%? So you can underwrite to multiple scenarios to see how your property is going to do in the event of interest rates going up. And then you could also get longer term bridge debt. So maybe instead of getting a 2-year bridge loan, maybe you get a 3-year bridge loan, or maybe you can even get a 5-year bridge loan. There's actually bank bridge debt that you can get that's for 5 years, and it's actually fixed as well. And so, and then also you can just have larger cash reserves at the time. You're already doing a project that's based on projected cash flows. It doesn't hurt to have a little extra cash on the side in the event everything doesn't go perfectly. So now we kind of get to where we are today. And, As I mentioned, we have fixed, we had the agency fixed, and we had Freddie floaters and bridge loans. And then now we've kind of moved in this era of assumptions and short-term agency debt. And so people are, if you were able to lock in a low rate, maybe in this region, then you can, when you sell the property, that loan can be assumed by the buyer. And so you can actually, some of the sellers that are going to market might be selling the property, and you can get a low rate loan that comes with the property at, say, 4%. And so a lot of people are buying properties and assuming loans now. And then when they're buying properties, maybe they're getting shorter term debt. So instead of getting a 10-year fixed rate loan, they're getting a 5-year fixed rate loan. And so, yeah, I'm going to kind of move through here and also make one more comment about interest rates. I don't know if y'all remember kind of this what was kind of said at the time. The Federal Reserve was coming out and saying that inflation is transitory. We don't think it's a big deal. That's why we're going to keep rates low. And what ended up happening was inflation wasn't transitory and ended up raising rates dramatically. So just keep in mind that nobody knows, even kind of the smartest guys in the room. And here's kind of where interest rates are anticipated in the future to go, actually. And so interest rates are, the market, right? We learned from this chart that nobody knows what's going to happen to interest rates, but the market right now is thinking that interest rates are going to go lower. I would just say, based upon this chart, you should assume that nobody knows. Okay. Now, what typically happens is the market's typically right in direction, but they're wrong on timing. So interest rates eventually did go up, but it just happened, 10 years later, or 8 years later. Interest rates eventually went down, but it didn't happen, necessarily immediately. And so they thought interest rates were going to go up again. Yes, they went up, but not to this level. And so right now the market's saying, oh, interest rates are going to go down. They think it's going to go down, but they also thought rates were going to go down here, and they also thought rates were going to go down here and here and here. So you just don't know what's going to happen to rates. Also, this is just kind of showing, where cap rates have gone as well. So this orange line represents cap rates, back in 2000, looks like cap rates are around 8.5%. And, now we're looking at, they got as low as, I would say, 4.5% for Class A nice properties. And now they're, I would say, around 5.5%, depending on what class of property you're talking about. Even 6%, 6.5% if you're looking at maybe something that's a Class C property. One more point that I also make is, especially in Texas, taxes and insurance have really, really hurt real estate owners. And so, the counties have really been pushing taxes up on real estate owners. And then insurance costs have just gone way up as well. I remember doing a loan in Galveston. That was like, the insurance cost was like $1,500 per unit. And now that's what Houston's looking like. Back in the day, that was like a Galveston price, which you would kind of understand considering it's right on the water. But now all of Houston's $1,500 a unit as well. And so, insurance costs have gone way up, which when you combine that with interest rates and taxes going up, it's just, there's the expectation that there's going to be a lot of distress in the future. And so, I thought this was also an interesting chart here. This is what the market thinks are going to happen to interest rates. Market thinks they're going to go down. The SOFR, that is. However, here's what the Federal Reserve thinks are going to happen to interest rates. So they also think they're going to that the interest rates are going to go down as well, but not at the same speed as the market. And I would place a bigger bet on what the Federal Reserve. If I were to project interest rates out in the future, I would place a bigger bet on what the Federal Reserve thinks is going to happen as opposed to the market. And so you have January 2024 here. And so this is January 2025. And so it looks like rates might drop a little bit, but not by a ton. Okay. On short-term floating rate debt, that is. Here, one more, just a couple more slides here. And then here's the 10-year treasury. Here's actually what is anticipated the 10-year treasury will look like into the future as well, based upon the market. So right now the 10-year treasury is between 4 and 4.25, and it's expected to go up from here based upon the market to say close to 475. Who knows? But that's kind of what the market is communicating now. So in terms of loan terms, and kind of what I recommend, on the smaller loans, I would say you have kind of three major options. And this is really, and I'll just kind of walk through these real quickly. So you have a bank loan option here, a bridge loan option here, and then a Freddie Mac SBL option. This option right here is only available for multifamily. I'm not sure exactly what all the properties people are buying on this webinar, but these are all kind of, all the terms in here are kind of really based on multifamily. So with a bank loan, there's no minimum loan amount. With a bridge loan, there's $1 million. In Freddie Mac, there's $1 million minimum loan amount. Obviously, with bank debt, you can get a lower interest rate. And the reason is it's because it's recourse. It's a full recourse loan. But you can get 8.5%, 9% fixed for 5 years, which is pretty nice. Whereas a bridge loan is going to be a little bit higher. It's going to be, say, 10.5%, fixed for maybe 2 or 3 years. But you can also get non-recourse, which is nice if you want a non-recourse loan. And then Freddie Mac SBL rates are even lower, say 6.5%, 7% right now, non-recourse. So that's kind of on the smaller side. With regards to prepayment penalties, and that was kind of a big part of our discussion today. What's nice about a bank loan, even though you have recourse, is you get a step down or no prepayment penalty. With a bridge loan, you can have 1% prepay, but you have a really short term loan, so you have to be cautious of that. Because you don't know what's going to happen to rates in the future. You don't know what's going to happen to cap rates. You don't know what your takeout loan is going to be if you end up deciding to refinance. And then your Freddie Mac SBL. What's nice about these smaller agency loans is you can get a step down prepayment penalty here, which is really nice. Now on the larger side of things, I would say for bridge loans, if you have greater than $3 million loan, you can actually get a 9% rate. So not that 10.5, but you get a 9% interest rate. It's also non-recourse. There's no minimum occupancy requirement either. Really because they're underwriting to projected cash flows. For Fannie and Freddie, if it's greater than $7.5 million, you can get an even lower rate. I would say maybe even as low as 5.75% right now, 5.75%, depending on what type of leverage you get, to maybe 6.5%, and also depending on Fannie and Freddie, they really encourage lending to properties that are serving the lower income community. And so if you have rents that are lower, typically you get a lower interest rate. Now the problem with these larger loans though is that you can get a step down prepayment penalty, but it's really expensive. I mean, you're going to add probably 1 point to this, maybe even more. And so that's why typically yield maintenance is what people get. But I would say instead of getting yield maintenance, maybe get a modified yield maintenance. Instead of getting a full yield maintenance loan, maybe get what's called like a 5.7 yield maintenance, in which basically your yield maintenance burns off more quickly, and that your prepayment penalty will be lower more quickly as the loan comes to maturity.